Level 1. $247 in buying power. You have $247 in buying power at 6:32 a.m. on a Tuesday. The laptop sits on your kitchen table, next to a coffee mug with lipstick marks from yesterday. You're watching a pharmaceutical stock gap up 11% on FDA approval news you read about in a Discord server at 5:50 a.m. You buy 18 shares at $13.72. The position moves to $14.01 in 4 minutes. Your hands are shaking slightly. You sell at $14.03 for a $5.58 profit after fees. You are a day trader. You tell people you trade for a living. You made $5.58 in 4 minutes. You have made $412 this month. Your rent is $1,340. You apply for a restaurant job that afternoon. Level 2. Pattern recognition at $25,000. 16 months later, you have $25,000 in your account from a tax refund, saved restaurant wages, and a loan from your sister that you will repay. You are trading momentum breakouts on the 5-minute chart using a scanner that costs $197 per month. You identify the same setup 40 times in a month. It works 23 times. You make $8,400 in your best month. You lose $3,100 in your worst. You are averaging $2,900 monthly over 6 months. You quit the restaurant. Your sister asks about the loan. You tell her 2 more months. You are watching a stock move against you at 2:17 p.m. and you know you should exit, but you don't, because if it comes back, you won't have lost money. It doesn't come back. You lose $840. You know this about yourself now. You still do it. Level 3. Risk management at $180,000. You have $180,000 in capital. You are trading 2,000 to 4,000 shares per position. You use a risk management system that cuts losing positions at 0.8% account loss. You follow the system. You make between $11,000 and $19,000 most months. You have made $147,000 in the past year. You pay estimated quarterly taxes. You fund a SEP IRA. You repaid your sister with 8% interest she didn't ask for. You rent a 1-bedroom apartment with dedicated office space. You are invited to a Discord group for traders with verified 6-figure accounts. Someone in the group mentions a prop firm offering 10-to-1 leverage on proven strategies. You schedule a call. The firm reviews your track record. They offer you $500,000 in buying power. You accept. You are trading other people's money now, using the same patterns you identified on your kitchen table. The patterns still work. The money feels different. You notice this, but you don't examine it. Level 4. Institutional access at $4.2 million. You are managing $4.2 million across 3 prop accounts. You are making between $47,000 and $83,000 per month in performance fees. You are 31 years old. A recruiter contacts you about a position at a proprietary trading firm in Chicago. They have seen your performance data. They offer $180,000 base salary plus percentage of profit on firm capital. You will trade $15 million in firm money. You will have access to institutional order flow data, level 3 market access, and co-located servers 4 milliseconds from the exchange. You accept. You move to Chicago. You arrive at the office at 6:50 a.m. and leave at 4:30 p.m. You are trading the same breakout patterns, but now you see the order flow behind them. You see when institutions are accumulating positions, they will later move. You see the buying before the breakout happens. Your edge is no longer pattern recognition. Your edge is information asymmetry. You make the firm $2.8 million in your first year. They increase your allocation to $40 million. You buy a car you don't need. Level 5. Volatility arbitrage at $600 million. You are 34. You are the lead trader on a volatility arbitrage desk, managing $600 million. You are trading option spreads, variance swaps, and correlation products across equity indices. You are not watching price movements anymore. You are modeling implied volatility surfaces and their deviation from realized volatility. You are exploiting pricing inefficiencies that exist for 40 to 90 seconds. Your algorithms execute 1,400 trades per day. You monitor them. You adjust parameters. You explain variance to a compliance officer who doesn't understand the math. The desk makes $47 million in a year. You are paid $890,000. You are dating someone who works in marketing. She asks what you do. You say you trade derivatives. She asks what that means. You start to explain volatility skew, and you see her eyes, and you stop. You say you trade stock options. She nods. You don't bring it up again. You notice you have started describing your work in simpler terms to everyone. Not because they can't understand, because explaining it correctly takes longer than you want to spend. Level 6. Market making at $8 billion. You are 37. You are a market maker for a firm with $8 billion in deployed capital. You provide liquidity in 340 equity names. You are not taking directional views. You are capturing the spread between bid and ask across thousands of transactions per second. Your algorithms quote both sides of the market continuously. You make money when other people trade. The more volatility, the wider the spreads, the more you make. You are not hoping for market moves anymore. You are hoping for uncertainty. A geopolitical crisis in September increases your daily profit per unit from $0.0047 to $0.012. The crisis involves currency devaluation in a country you have never visited, affecting 40 million people. Your desk makes an additional $3.2 million during the crisis period. You are paid a $1.4 million bonus that year. You donate $15,000 to disaster relief. The money comes from the same account. You are aware of this. You file it away. Level 7. Proprietary strategies at $35 billion. You are 41. You are the head of proprietary trading strategies for a multi-strategy fund managing $35 billion. You oversee 19 traders across equities, fixed income, commodities, and derivatives. You do not execute trades yourself. You allocate capital to strategies, measure risk-adjusted returns, and report to the CIO. You sit in meetings about correlation breakdowns, tail risk hedging, and liquidity management during drawdowns. You are trading the structure of the market itself now. You are positioned for dislocations, panics, moments when normal relationships break. Your fund made $240 million when a pension fund was forced to unwind $8 billion in positions over 4 days. You knew the unwind was coming. You positioned for it. The pension fund's beneficiaries are teachers. You know this because it was in the news. You explained to the CIO that the trade was based on technical factors and positioning data. This is true. The trade was also profitable because someone else was in trouble. Both things are true. Your son is in 4th grade. His teacher is probably in a pension fund. You don't know which one. Level 8. Systemic integration at the top. You are 44. You are the chief investment officer of a $60 billion fund. You do not trade. You do not model. You allocate capital across strategies, monitor systemic risks, and interface with the largest institutional investors in the world. You sit in rooms with sovereign wealth fund managers, central bankers, and pension overseers. You explain how you generate returns. You use words like uncorrelated alpha, risk-adjusted, and systematic. These words describe extraction, but they sound like engineering. You are paid $8.2 million per year. You have $34 million in assets. Your children attend a private school that costs $52,000 per year each. You are on the board of a financial literacy nonprofit that teaches underserved students about investing. You believe in the mission. You fund scholarships. A student asks you how you started. You tell them about the pharmaceutical stock and the kitchen table and the $5.58 profit. You do not tell them about the order flow data, the institutional access, the information advantages that compounded over 20 years. You believe you are being helpful. Somewhere in a one-bedroom apartment, a 28-year-old is watching a momentum breakout at 9:47 a.m. They have $890 in buying power. They think it is about pattern recognition. You remember thinking that. The market opens tomorrow. It always does.